morning, everybody. Thanks for joining us today. We're just broadcasting from the Bahamas and Key West, Florida. Thank you for joining us today. As all of your friends populate the Zoom call here today, I'll just make a couple of housekeeping items. As you're probably all aware, we certainly welcome from the Family Office Insights community as you dial in here and log in on your computer as we go along. Please feel free to ask questions, whatever comes to mind, and we'll get to them. You can do that either through the Q&A or the chat box, and please feel free again to do that when anything that comes to mind, and we'll be monitoring them as we go along. This is the second time we're going to have our guests here today, and we have an interesting opportunity, as you all have seen with the invitation, and we're going to be introducing our friends here in a moment. And as I mentioned earlier, or in the prior calls, we record this and then we're going to post it on the Family Office Insights YouTube channel, so you can share it with others if you like. And we encourage you to do that. And during this call, if there's anybody that you think we should be chatting with as you learn what we're doing here, then we welcome that in introduction as well. So with that, I'm going to hand it off to Santiago, and he's going to give you a little background on the team, what they're doing there, and then the opportunity.
Thanks, Arthur, and welcome everyone. I guess before we kick off, I'll leave Tom just to make a few remarks on VCM, who we are and how we work, and then I'll just jump into the opportunity.
Great. Thanks, Santi. My name is Tom Vukota. I'm the founder of VCM Global Asset Management. We've been around for over 10 years. We manage roughly $800 million. We have about 1,200 full-time employees as part of the different companies we've invested in and part of our infrastructure across North America, particularly in the United States. We have an office in Denver, Nassau, Bahamas, Geneva, Switzerland, and Toronto. And basically, we're focused on opportunities where we have attractive risk-reward payoff. So we're not just looking at generating returns, although this particular transactions, the potential returns are exceptional. We're really more focused on, what is our downside in relation to our upside. And I think as we go through this particular opportunity, you'll see that relationship is very much in place. As far as our approach, we're very much involved in the different entities we invest in. This particular opportunity, we have 2 board seats. And we're in daily communication with the company in terms of strategy, in terms of working with bringing on potential customers, users to the platform, and it's really a value-add approach in order to create value and create a successful exit for investors. I think that's kind of just a general overview on VCM, and we'll get more into the details of this opportunity. I'll let maybe Santiago give an overview of the company and why we're so excited about the opportunity.
Thanks, Tom. So one important thing to flag before we kick off, this is one of those that, in order to be fully transparent in terms of the company and obviously a lot of color we have on the business side, revenues, pipeline, and others, we will need an NDA, but we will try to share as much color as we can. And as Arthur said as well, please feel free to ask questions, make it interactive, and it's really to try and make it the most out of it for you. So what is this about and why we are so excited? It's an opportunity to disrupt the FX space. So when you think about it, equity has been disrupted close to 15 years ago. Now it's fully electronically, and anyone can buy, at the same price anywhere in the world, even from your phone. Fixed income has been going through a big shift, especially in the last 5 years. There's a big player, market access, that dominates the electronic trading of it. And FX, it's still, in spite of being actually the largest in terms of traded volumes, it's still extremely opaque, right? And the preferential pricing transparency, it's only available for very few participants. So the whole genesis of this opportunity and the company comes from a spin-off of a very well-known and established UK FX asset manager. They've been around for over 25 years. They manage around $20 billion. And as a consequence of their business, so they manage money from one of the largest and renowned institutions in the world. Again, under NDA, we share who they are and you'll know them. They trade close to somewhere between $600 and $900 billion per year in FX volumes, right? Making them one of the few FX dedicated asset managers out there trading these volumes. And as a consequence of that, they developed a very strong IT infrastructure, banking access, relationship, reputation, and others, in order to trade for their own books. And the asset management side is still going, and basically the fintech side, so sort of like you can think it as a sister company to the asset manager everyone knows, has been developed roughly 2 years ago. And this is the opportunity we're talking about, which is basically externalizing everything created in-house to trade for their internal asset management side now to the mid-market. So what's the mid-market? The target is, we're not targeting here retail. So as you know, Revolut, TransferWise, and others have tackled that space in the last year. There's been strong revolution, especially coming from the UK. That's not what we are after. And also additionally, the very large guys, so when you're thinking about extremely large corporates or very large pension funds or hedge funds, they don't need us as well, right? All those guys, they can take care of themselves. They already have the good access to the market. Everything in the middle is the market we're targeting, which is why we're so excited, because the market is really huge. And the potential as well, and I'll tackle more into that, there's some very large players in terms of volume, although they don't have the level of sophistication, which can really benefit from this platform. This is a bit on some rough numbers. Arthur, do you want to ask anything?
Yeah, no, I just wanted to, I think it'd be helpful to clarify the trade or the transaction that you're likely to be servicing. Is it the FX trade itself, or is it the put and calls on the FX trade, or is it all of the above, hedges and that sort of thing?
Okay, so the platform, it's targeted, first, some important distinction. First, in terms of business model, there's nothing out there, as far as we are aware and our due diligence says, that has the same business model in terms of transparency and access. In terms of which products we can trade and who are we targeting, you have to think that this is not targeting, a high-frequency trader or a trader sitting in a hedge fund, sophisticated. This is going to be pretty simple, easy-to-use platform with great market depth, size, pricing, but very basic functionalities. In terms of what we can trade, it's going to be spot and forwards mainly. In a few months, we're going to be developing options as well. It can support NDFs as of now. And we have the licenses as well for payments within the platform. There are some other functionalities as well that are going to be developed in the next probably 6 to 12 months, and we can talk more about that, but it's linking to client retention and others within the platform. So we're going to have access to research first coming from the parent company, but there's ideas of becoming in a marketplace in terms of trading signals, robo-hedging, even maybe some baskets within the FX space. And also additionally, a functionality to be able to deposit overnight rates with different banks. So it's really targeting there all the treasury services from a traditional corporate or asset manager, and be able, to, if you have extra cash, deposit with different banks, do your FX coverages either by options, futures, or forwards, NDFs, and then also spot FX. So I would say the whole broad range within the FX space.
And I know that you're going to get to this, but I think it's really instructive to understand that this is already operating and robust and being used, and not a startup in terms of that it needs to be built there's
maybe I'll just talk to that a little bit. Basically, that's a good point. So, you look at a lot of opportunities with, this kind of upside, and, I've been doing this for almost 25 years. I've seen thousands of projections, hockey stick projections. And this is the first one I really believe in, because the parent company is one of the biggest players in foreign exchange FX overlay management in the world. They're doing 800 billion a year, as Santi outlined. And so if anyone's going to do it, they're going to do it. And if you look at we'll go into some of the slides later, but if you look at the banks that have been signed up on this platform, it's 9 of the largest global money center banks that specialize in foreign exchange that have come onto the platform. And essentially, that's a big endorsement. And so if someone's going to do it, they're going to do it. And this market is so large, it's trillions of dollars a year. So 100 million EBITDA projected is not necessarily pie in the sky. They can execute, they can do it. And so when you look at where they are, it's not a question of, when you look at a lot of early stage companies, you have to try to validate the product, the service, and there's a lot of unknowns. And of course, the return is a function of that. Here, we know that people are using FX on a daily basis in the trillions of dollars. So you're not trying to sell them something that they don't need. And so it's really a function of what is the differentiator, what is the value add, what are the cost savings. We'll get into more detail, but those are pretty black and white. And so we can substantiate very material cost savings. And so this round is really to ramp up the sales and marketing on a global basis. And so it's not to validate products. It's not to determine whether or not somebody needs this or not. And, the other side of it is we're already onboarding clients, and we'll get into some of that. I mean, very substantial clients, very large funds, very large users, and it's basically starting to ramp up. And I think one other item that kind of ties into this, where I think there's a lot of questions that we had originally when we started looking at this, was, well, why is the parent company, which manages 18 billion, trades 800 billion a year, why do they even need any money? Why don't they just do this themselves? And so basically the background is this was brought up internally as an idea, and the parent company's in the business of managing money. They've been doing it for 25 years, not in the business of investing in startups and whatnot. Even though this is related to their business, it's a transaction business versus a money management business. And so basically it was determined that they would invest 5-6 million, provide all the infrastructure, provide all the support, get it to a point where it's ready to launch and bring on customers. And then any marketing costs, they would have to bring in third parties. So that was the deal that was made internally, number one. Number two, this is a hedge overlay business, so that the parent company charges 5 to 10 basis points. And so if you extrapolate that on, let's say 20 billion under management, yes, it's profitable, but they have a lot of overhead. And so it's not like a hedge fund or a private equity firm that manages tens of billions. And so they can certainly fund. They funded 5-6 million to date. They can fund the balance over the next 2.5 years. However, they want to basically be first to market and really capture as much market share as possible. So it makes a lot of sense when you look at it from that context, why they're bringing in investment capital to wrap this up as quickly as possible on a global basis.
Yeah, I'll add to Tom and Arthur, please, if there's something follow-ups, let us know, because I think this is an important point. But in terms of where the company stands, all the major de-risking has been already achieved. When you look at the regulatory side, and we can get into details with those under NDA, but all the licenses approvals the company have executed faster than initially thought, and all this time we've gained, they have 100% of everything we need as of now to operate in different markets globally. The platform, it's already live and trading. All these banks that we have in the screens have already agreed and are live streaming now quotes. The first client is expected to start trading probably next week. And there's a pipeline that I'll share a few more details later, where you can see the potential and the onboarding process. And there's a few clients already being onboarded. So really the whole idea of bringing VCM, and I'll just say a few things on how this deal came about, and which I think it's important color. It's a completely off-market deal. So we know the founder of the parent company. It's a good friend of ours, both myself and Tom from here, the Bahamas. Extremely close personal relationship. We have a lot of friends in common, and we know both groups. They've been looking at different deals we do, and basically 8 months ago now is when we started due diligence initially on this deal. They told us where they were, what they were doing on this transaction, and that's how the whole story came about. So it's one really completely off market, no broker involved, and it's one where the relationship, played a big role. And then lastly, saying they were talking with a few large institutional players, but way more passive than us. And in the end, the idea of doing this together with VCM is clearly our active approach, what we can bring to the table. And then lastly, is the fact, as Tom mentioned, they could have continued funding by little, but the idea is to get the most out of the first moving advantage. There's no one right now with this business model. This can massively disrupt, the whole space. And the idea is, okay, we'll bring the capital and the brains in place to really get the most out of where we are. So it's really one of those where the whole platform market has been reached and de-risked. And now the capital is bringing to really scale the business from here.
Guys, one of the things, because I've had the benefit of talking to you prior and seeing this once before and then having some background on it, in talking to some of my colleagues and friends who allegedly are in the know about inside deals, let's just use Silicon Valley for a second, and they all believe that they have an opportunity to invest in things where people wouldn't otherwise have an opportunity to invest in them because of the inside nature of Silicon Valley. There was a fair amount of FOMO when I was talking to them about what you were doing, because saying, if this deal is what it is, then how is it that we don't know about it? And I said, well, then it's exactly this. It's the relationship that you guys have with the founders, and that's what catalyzed the whole thing. So there's some fear of missing out from the West Coast, just to be clear.
Yeah, it's something I'm glad you mentioning, and just a quick remark. I'm very much convinced, and with Tom we are, that this is one of those that if they would have gone through a broker or marketed Silicon Valley, and top VC funds in London would be all over it, right? Given who the parent is and what's the value proposition. And yeah, we've been a bit lucky, but also we pressed the gas. And just so you're aware as well, from the full raise, we have already invested 4 million. We are the largest investors, both myself, Tom, and other key members from our firm. And with that, we've been working quite actively already with the firm. We've been both sitting already in the board of directors for a few months. And yeah, it's one of those where we are extremely close with the company. In terms of the parent, I think there's not much more to add. Obviously, we'll disclose the name and others later. But the VCM, we tend to focus on asymmetric payoffs when we look at investments. We put a lot of efforts on the downside. We tend to focus on mature businesses, and clearly the parent, the heritage, the reputation they have is one of the things that mitigate a lot of the risks you tend to have in this kind of deals. So when you look at a transaction in the fintech world, and where yes, you can make 10, 20, 50 times your money, but obviously in those it tends to be very high downside risk. Well, this one, a lot of the mitigations, not only by the structure we created, and we can touch on that later, but also the whole heritage from the parents. And again, we will disclose the name and a bit more color. This will be very clear, but it's one of the largest players. They pretty much never lost a client in their full 25-year history. And the relationships they have with the sell side and banks out there is obviously super strategic for us, even especially as well on all the regulatory fronts. The fact that we've been able to get approvals in the UK, the US, we are fully MiFID regulated, payments institution in the UK. All of that obviously has to do, it's not that a new fintech in the space, when they are waving their hands and trying to get an approval. Obviously, we went there with the parent company and with the whole heritage together. I guess one more thing in terms of interest aligned in this transaction, and something that makes us super comfortable, other than the fact that we know the company, is that it's the son of the founder of the parent. It's the CEO of the fintech. So clearly, all the interests are extremely aligned, and all the money and the capital we are bringing in are just to grow all the business. There's nothing here that anyone is taking out from it. So in terms of business model, on this one, there's two on how the company is going to generate revenues. It's a pretty simple model, but basically it's different. So we will charge a market transaction. So in terms of how different this is a platform versus everything existing out there, it's going to be fully transparent. So you're going to be able to log in securely. And then let's say you want to buy 10 million euro Noki. You'll be able to see all the largest competing banks out there showing the bid and asks. They're transparent. So we're going to be effectively showing the cost of goods. So when you think about that, there's very few industries where you can see the cost of goods. Would be like Nike telling you how expensive it is a shoes to make. And even more in such an opaque market like FX, right? So the business model here is going to be a markup predetermined before, multiplied by the volume of each transaction. And then a very new, not seen in the industry, which is getting a lot of traction, especially for large clients, is sort of Netflix subscription model. So we are offering as well clients to pay a fixed fee, and then you can basically eat as much as you want. So they'll be able to trade at the same cost of goods that the parents can in any volume they want. And from an investor perspective, it's extremely attractive. So you will be looking at a company that has long-term contracts, stable revenues, which is pretty much unseen in this kind of business, right? When you look at different brokers and others out there.
Yeah, in simple terms, you've got the pricing availability as a customer to get the pricing of a firm that does 800 billion a year. And so at the end, it's kind of almost like you have a Costco membership, and now you have all these volumes. You get the benefit of that by virtue of your membership. And here you're basically paying 5 basis points. And let's say you do 100 million of FX, now you're getting a pricing of someone that's doing 800 billion. It's as simple as that. And I think the other thing to understand is when we first, we've been working on this and doing a lot of due diligence, as we always do for now 5-6 months. And essentially what we determined based on our due diligence is they could charge substantially more. And I think it's, to some extent, it'll depend on where the customer is located, what volumes they're doing. But the mindset from the company standpoint was by charging cutthroat pricing, they're going to create significant barriers to entry in terms of, in the long run, new entrants, and they'll have sticky clients. And, when you think about it, kind of like Amazon, they realized 15 years ago, e-commerce was going to be, displacing conventional retail, and they invested billions and billions and billions to build infrastructure and scale. And, they don't have anything proprietary in the technology world that other people can't figure out, but they've created that scale to the point where there's a huge barrier to entry. It's almost impossible to compete. And I think that's kind of the mindset here, is really, let's not be greedy. Let's go after the volume. The volume is there. There's so many inefficiencies. And if we can capture that, we can retain our clients and create this residual cash flow and income.
Already touch on that, but basically in terms of where the company stands and the risking we mentioned, all of these banks are already live streaming the platform. There's also conversations with another 15 banks or so, and even other also ancillary liquidity providers. There's some companies which are starting to try to compete with banks in terms of crossing orders with different clients, that's especially on the large asset management side, and we are even in discussion with those. So when you see the whole space as well, you have to see those not as competitors, but basically to another route to provide liquidity within our platform as well.
And just one other question, some people ask is, why would the banks all of a sudden want to sign up on this platform and essentially?
Hang on. You were breaking up there for the last sentence. Let's try it again.
Okay, is this more clear?
Much better.
Okay. Some people ask, and it's a very legitimate question, is why would the banks sign up to this platform and potentially give up valuable margins by virtue of their existing customers trading on this platform? And I think, at the end of the day, if you look at the insurance space as an example, when insurance exchanges and online bidding came about, 10 years ago, 15 years ago, a lot of insurance companies said, oh, we don't want to bid. Why would we? We're basically impacting our margins. But the ones that were forward thinking went on the platform thinking, you know what, this is where the world is going, number one. And number two, it's going to allow us to capture customers that we otherwise wouldn't have. And in aggregate, we're better off. And so a lot of insurance companies that didn't want to go on the platform, guess what? They're all on the platform. If you're not on one of these insurance exchanges bidding, you're out of business. And so I think at the end of the day, the ones that are on here realize exactly that. And then secondly, there's been a big shift within the whole, trading floor and in terms of the bank structures where they need to maintain a certain level of clients in terms of size in order to make money. And they're offboarding a significant amount of clients because they're not profitable. And so there's that whole trend where they want to deal with the biggest of the biggest clients. And then also by being on this platform, they're going to have access to customers they don't have. As an example, we're onboarding some, a fairly large company in Canada that does, my background's Canadian. I have a lot of relationships in Canada, but essentially the company does about $100 million a year in FX, and the bank is charging them $900,000 a year in transaction costs. By going on this platform, they're going to save probably $700,000 a year. I mean, that's mind-boggling. These are recurring costs. So if you apply, let's say, a 10 multiple, it creates $7 million of value. But when you think about it, all those banks on that platform now, and indirectly, they're doing business with this company in Canada, which otherwise they would never have a relationship. So when you look at the big picture, it makes a lot of sense as to why the banks would want to be on it. And instead of dealing with thousands of clients in the mid-market, now they're dealing with one big client, because ultimately everybody that's using this platform, it's really one client. The banks don't know who's actually trading on it. And essentially they're happy to trade, $2 trillion a year versus having thousands of traders doing 100 million each.
Go back a few slides. I guess we're already touched on that. I'm going to go quickly to the market segments. If you bear with me. So I think this slide is important, and I started with that by going into Tom's comments on the banks and who are we competing with, where we are taking wallet share from whom, and where are people trading right now. I think it's important to understand the whole landscape and where the opportunity lies. So I'll start first. I mentioned before, when you look at consumers or very, very small businesses, also sort of the retail space, the B2C space, we've seen a lot of players coming on there, like Revolut, TransferWise, and others, and that's happening right now. And those clients, just to be clear, we are not targeting those, right? So the very small clients, it's not something that they will be having users to the platform, right? On the other spectrum, when you look at a very large clients, and there's other firms there, and we've got in the past as well some questions like, oh, but 360T does something very similar, and most of those companies in there are software providers. So by that I mean it's a price aggregator, but the pricing power, which is the main difference we are giving, is not here. So what do I mean by that? And Tom made a point on that, but I want to reinforce it, is the fact that this Canadian agriculture company now, we have the same pricing power as the parent company that trades $800 billion a year and have been doing so for 25 years. If you use 360T, the only thing that does is a software aggregator where already the different lines and pricing you have with banks, it's all in one system for you to trade, right? So basically in all the large clients as well, when you're thinking who can be a user, you're thinking like Google, Apple, that have massive balance sheets, or Brewan Howard, or other hedge funds or very large endowment funds. They don't need us, right? They already have trading lines, and it's very likely that they already have a very similar setup to what the parent company of ours have, right? So everything in the middle is what we're targeting. And I'll give a bit more flavor here without disclosing client names, but we thought initially one of the first assumptions when you look at the whole landscape was size matters, right? And we thought, okay, people trading, we started saying, okay, people trading probably more than $1 billion a year must know what they're doing and must be taking care of themselves, right? So there's no need for us to get involved with those. And that assumption was completely wrong, which clearly shows the potential of this. And I'll go into one example because Tom mentioned just one, and maybe you say, okay, but they trade 100 million, it's low. They are farmers, right? They're extremely successful company, but they know nothing about FX. But what about larger clients, right? And we have an example, I'll jump into that, of an asset manager close to $6 billion in AUM. So this would be one of those where we thought, okay, they're asset managers, they are in the financial space, they're pretty large, they know what they're doing, they don't need us. And through the connections of the parent company, and that also addresses one of the questions of, does the parent company compete with this? Doesn't compete at all. There's even lots of complementary businesses or help that can be done between both, but it was a referral from the parent company. And basically, this is a large private debt asset manager. So as part of their requirements, what they do is they have different currency share classes. As we all know, you can buy a fund in euros, sterling, dollars. So basically, in around 2 billion of their AUMs, they need to do currency hedging, right? So it's very basic but manual process they used to do. By that, I mean, every month you calculate the inflows and outflows. They had monthly redemptions and monthly liquidity. And you have as a manual process, they were calculating how much of the hedge you have to close, how much you have to open again, and they were computing those trades. They were doing it with their custodian bank. We'll disclose the name under NDA, but they were doing it with a custodian bank. And they were custodying with them 6 billion. They've been with them for a long, long time. We told them, look, what we can do to you, and it's part of the sales process, we'll do an independent third-party trading cost analysis, sort of an X-ray to really determine how much you're paying. I mean, FX is so opaque that sometimes people really don't know what are the hidden costs, and they really didn't know. So we did that independently, and when we did the analysis, we found out we could decrease costs by close to 70%, right? So by virtually moving them to our platform, they could save 70% of their costs right now. And guess what? Their trading volumes are going to be, to start with, and this client is going to be trading, to be transparent, starting next week. So this client is real, it's onboarded. We're going to be trading now close to $25 billion a year in FX volumes. And if they onboard the full funds they have, this client could trade up to $50 billion per year. In spite of that, they didn't have a good setup. We can save them 70%. Added to that, and obviously money, it's one of the key differentiators we have, but we have always been the case, and it happened the same with the agriculture business and others we referred, or other case studies we have, where the platform, the feedback has been extremely strong, and it's not only pricing. So on this one, instead of having now a manual process, a trader calculating what the hedges amount are, and then picking up the phone and trading, all is going to be IT driven, automated. So for them, it's extremely simple now. There are no manual errors involved. The company is going to be saving lots of money. And this is a client that is going to start generating around $1 million in revenues for us, and potentially 2 million when they're at full capacity.
Yeah, I mean, just on that point to further elaborate, again, the middle market, so to speak, is obviously a lot wider when you look at, $100 million company with this agricultural company in terms of volume versus 25 billion. And so it's a massive market and tremendous opportunity. But just in terms of, getting back to the economics of the business, why it's so attractive is, in this example, this is a customer that can, contribute, let's say, 2 million a year in revenue. That the contribution margin on that revenue is, 95% plus, close to 100%. And so when you think about these are recurring volumes. And so at the end of the day, once you cover your fixed costs and you add on new clients, it's just incredible in terms of what falls to the bottom line. And then I think the other thing, which is really important, when you look at fintech in general, there's a lot of fintech companies and different models, and a lot of them are focused on the mass market. And so when you look at your return on customer acquisition costs, that's a very important metric which a lot of people don't focus on. You really need to have a lot of customers, and the return is minimal. And so to make it work, you really have to scale up, otherwise the whole business fails. Here it's the opposite. your return on acquisition cost, customer acquisition cost, is almost infinitesimal, because in this case, this is just based on a relationship, and you're generating 2 million residual a year, and notwithstanding that, even if you have a sales force, you're targeting these customers that are generally going to generate several $100,000 to $1 million a year in recurring revenue, and so you can see why the business model is very attractive and just generates incredible returns on capital.
Yeah, which I think is an important, and it makes us feel much more comfortable. And one thing we didn't mention, which is the route to profitability, when you look at others in the sector, and even when you go to some of the successful stories, as you saw before, especially on the retail space, here is much, much faster, the route to profitability. And just to be clear on that one, this is the first and only external round that it's being done, and we don't oversee, and management doesn't oversee any other raise. They're so confident about that, and which we structured in terms of our investments. We also have anti-dilution rights. So
should we get in? Is there a structure piece? I guess on that point is essentially this is the only and final round, and there's more. It should be more than enough capital to create a runway and ramp up the sales, and then it becomes self-generating in terms of cash flow. I think the other thing to understand is 10 million of the 30 million is going to be basically sitting on the balance sheet just as cash, and so you can explain more of the principal model and all that. I'll just explain kind of the risk reward and everything. And so the pre-money value is 80 million, and a lot of people say, oh, that's a very high value and whatnot. And so this is kind of how we're looking at it, and we believe it's very rational. Is ultimately you have a real competitive advantage. You have high barriers to entry. From day one, the business has the scale of a parent company that's been around for 25 years. So they've basically transferred that scale and created this massive barrier to entry. And by virtue that the whole premise of the business, which it wouldn't otherwise be available. And so the value is more than justified from that standpoint, number one. Number two, again, as we discussed, a lot of the risk, it's been de-risked, all the execution risk, product risk, regulatory risk. Here we're ramping up, we're already onboarding customers. And so when you look at the upside, I would say if they hit their forecast, which I believe is achievable, if they were going public today, I would say I would be confident it would be a $5 billion company. If you look at some of the market comps out there with market access, they're trading at 80 times EBITDA. It's and they're probably beyond their really hyper growth phase. So, this is a much larger market, and again, trillions of dollars traded a day. So, in terms of how do you look at this from an asymmetric standpoint? If they hit their numbers and they're going public today, it would probably be somewhere in that 5 billion valuation. So, potentially you make 50 times your money. We're assuming 10 times, but just to give you the magnitude of upside. And then from a downside perspective, this is a real business. It's not kind of like, if it doesn't work, hey, we're going to lose our money. That's not the case. This is a real business. There's no service or product to validate. They're already onboarding customers. So we believe that this is going to generate even, a reasonable amount of cash flow and value. And so even if they were only to hit 5%, 10% of their forecast, if you extrapolate, put a multiple on that, your investment is more than covered by virtue of the liquidation preference. And so you look at the upside, the downside, it's pretty compelling. And then finally, out of the 30, there's 10 million of cash that's going to be on the balance sheet that's never going to be spent. It's a regulatory capital. So at the end, a third of your investment is also covered by actual tangible cash. And maybe you want to talk about, I think we've covered most of it, but I think just the last point that we didn't cover was the principal model and versus the current model in terms of how clients are onboarded. You can talk about the principal model. I'll just talk about the current model, which basically most of the customers that are in discussion, these are all institutional customers, and so they all have prime brokerage relationships. So the onboarding is fairly straightforward. Basically, they onboard and the funds settle with their prime broker, just like you would any other kind of DVP trade. So that's pretty straightforward, and there's no issues there. But the real opportunity beyond that is to bring on more, corporate type clients that likely don't have a prime broker relationship. And essentially the company would act as that prime broker, and that opens up a much larger market segment and the ability to charge, higher spreads. And that requires some regulatory capital initially. That being said, as it scales up, it becomes self-funding because those customers would have to post margin. I don't know if you want to elaborate on that.
It's really that where we are, which basically the next capital is now the company is operating at 100% potential. We already put 4 million. We're hiring people, and we can elaborate more on that later. But it's fully operational. The next scale where it's coming, it's really the principal model, which Tom was saying. So basically, it's sort of a chicken and egg. In order to have the lines open with the banks will ask you for capital. So 10 million of the investment is going to that. And this is really help expand the business from here much, much, much stronger, especially when you look at what are considered our small clients, which would typically not have access to a prime broker or direct relationship with the banks. Is where we are accessing with that one. So with this, basically the clients will be facing us from a credit risk perspective. And as Tom pointed out, we need the regulatory capital initially. It's important to say that we have very strong minority rights. So this cash is not going to be touched if myself or Tom doesn't approve it. And that's going to be the case for good, basically, for that cash. And does it mean we need more capital as we grow? Definitely not. So clients, as they go trading, we charge them initial margin and variation margins. However, their net exposures then go netting it up, right? Because one client might be long euros and then another one short. But the balance on our balance sheet is going to grow higher and higher. So basically, as we have more clients, more credit exposure, we don't need to be raising more capital. So from that perspective, we are covered and we can really scale the business from there. Arthur, I think you wanted to ask a question.
I just wanted to comment on the analogy that may be appropriate. I've seen this a million times like you have, but when you're talking about the expense and overhead to build, which is already done, then it's similar to a software where all you need to do is update the software, and the cost of building the software is already done. And so every software license that you sell is got a huge margin on it because it's an incremental cost. So in your comparison where you're saying that there's such a big margin on using this because all the heavy lifting and the overhead's not, the development costs have been done. So every sale, the preponderance of the fee goes right to the bottom line. And that reminds me of the business model and the revenue model of software companies.
Precisely, and that's why those types of companies trade at very high valuations. And in many cases, it's justified.
Yeah.
And I guess just one other item, and we can open it to some questions. But I guess even though we're a minority holder, in my career I've done a lot of deals, and the most successful ones have been generally minority positions where, and there's a lot of private equity funds. Everybody's smarter than the next person, and they want to buy a company. And my philosophy has always been, hey, somebody that built a business that's been in the industry for 30 years, 20 years, is going to know a hell of a lot more than I will. And I would rather back that person and really help them try to grow the business and together create a successful outcome, as opposed to just buy somebody who knows it and who's exiting. It's usually misalignment, and you should be concerned. But I think in this case, and you can do that. A lot of people say, oh, well, I want to, if I own it, I can control it and this and that. But synthetically, it's very easy to do that with agreements and control and governance and whatnot. So here we have 2 board seats, and we have a lot of in the deal, which we could share more specifically. We do have a lot of rights and controls and approval rights and things of that nature. And so it's not just a passive investment.
Yeah, I think it would be helpful, if you don't mind. I know that Santiago, you talked a lot about how much skin you guys have in the game, but can you talk a little, just recap that, that you guys put some capital in, the parent company is basically absorbed all the costs of building this. Can you just recap that?
Yeah, sure, and I think it's a very important point. And when you think about alignment of interest, how you feel comfortable downside, and I think it's a very important point. And again, under NDA and knowing who they are and others, we can share way more. But so up to now, there's the holding company, which owns 100% of the asset management that everyone knows. And this will be the sister company, the fintech arm, right? So up to now, it's 100% ownership up there by the parent company. If you want, we know extremely close the founder and chairman of the long-standing business. The son of him, very smart young guy, is the CEO and founder of the fintech arm. Just to get a bit of background there, he worked as an options trader in HSBC. Then he moved to the parent company as a PM on the FX side. So again, it's been always involved on the FX world. And then it's where this opportunity came about. Up to now, they are 100% the owners. We are jumping in with them. In terms of how do they see this and so on, they've invested already in the business 5 to 7 million real money. There's also a lot of intangibles, as Tom was saying, right? The reputation, the fact that all these large banks have already signed, the regulatory aspect. They've been borrowing as well a lot of resources. So obviously the help he had is much more than any other smart guy with a fintech idea. Been borrowing resources from infrastructure, IT, employees, office buildings. There's a lot of help down there, which obviously helps scale the whole business from there. The whole idea as well of how they're approaching this is, so the asset management is their long-term plan in terms of family and company. There's even succession plans of the CEO and founder of the fintech arm to be the CEO of the asset management side. And these, they are approaching it, which also makes us feel comfortable on how to see the whole deal as a sort of deal and trade, right? So obviously there's a little baby, there's a lot of effort, love, and passion into the company. We do have it as well, and we share it, but they more than us. And but they see this as an exit play, right? And they're the major holders up to now. 100% of the money is going to ramp up the business, and for the balance sheets, there's no exit at all. No one is taking any money out. So that's a bit how the whole structure is, Arthur, which makes us feel more comfortable. They have 100% skin in the game, and we are very much aligned in this transaction.
Yeah, and the goal is really to monetize this. We outline a 5-year exit, but obviously the fintech space and the valuations for these types of companies is extremely high. And I think if we can ramp this up as quickly as we're starting to, it's possible even in 2 to 3 years we create some kind of a public markets exit. But I think the time frame is kind of 3 to 5 years.
Yeah, the reason why recurring revenue businesses have such high multiples is because they generate cash, and if they're generate enough cash, sometimes it's not worth selling it till it generates more cash, right? And harvest that multiple. And
but like I said, some of these multiples are 50 plus times, 80 times, and so you kind of got it's a present value exercise. And I think at the end, if we can exit and create a higher, big profile for the company, could serve everyone well.
Yeah.
People could obviously, if you like the opportunity, you think it's going to grow, then you can always take some chips off the table and retain your investment and defer any taxes.
Yeah, is the company? It's kind of irrelevant. I'm just curious. Operating out of the UK, or will it be operating out of Bahamas?
So it's basically the head office is in London. The holding company is in Guernsey. It sounds like a complicated structure, but it's really quite simple and very common when you're dealing with international companies. And then our investment is actually it's a Delaware. I believe it's either a Delaware or Colorado. It's a US LP which holds the shares in the Guernsey holding company, and there's no withholding tax or anything like that. It's a pure flow through
Tax block. Yeah.
Correct. Yeah, and in the Bahamas. We have an office here. We're based here amongst other cities, but in the Bahamas, they actually have a subsidiary in order to facilitate sales to clients, in South and Central America. It's much more tax efficient to book the revenues here. And so we're helping them with that. And then I guess, one area where we're being very active is in South America. The spreads are incredibly wide, as you would expect. And it's a market that, they really didn't highlight when they were creating their business plan, but it's just tremendous. We look at the trading volumes, and it's a big export market. I don't know if you want to elaborate on that.
Yeah, well, on that, I think it's one of those, again, in what VCM brings. And I'm actually from Argentina. We've been doing things in LATAM with Tom.
Maybe tell your background. You worked at Morgan Stanley in London.
Yeah, so it's one of those as well why I'm so excited. So I spent several years in the trading floor of Morgan Stanley in London. I was on the fixed income space, so everything in terms of clients being off-boarded, how to focus on the largest clients, how tough it has been for banks to monetize this middle segment, why banks, and Tom mentioned it, why banks are embracing this opportunity, right, where they will have now someone they trust, going through all the orders. So that's a bit as well why, with my background, I get this whole opportunity. So I'm from Argentina, and we see a big market in LATAM. And you see, for example, a market like Mexico, so Mexican dollar, which is only one currency pair amongst all the ones in the world, is traded around $80 billion a day, right? And it's controlled by a bunch of banks. Spreads are extremely wide. The access to the market is very low. I'll give you a concrete example on the opportunity set we see there, but remittance business, it's a huge component, in LATAM, as you know, people that go work in the US and then they send money back to their families. And there's a mid-sized company in Mexico, we'll disclose the name and others and their NDA, but they trade around $5 to $10 billion a year. They're obviously extremely interested in getting the cheapest rate possible because that's their margin, right? They charge very high fees to their retail customers, and they're always trying to get the best rates. So, and also when you look at this sales process and a few of the metrics Tom mentioned and you, Arthur, were pointing out. So how did the sales process came about in this one? We are helping them, grow the business in LATAM actively here at VCM. We made a call with the CEO. They heard the business model. Obviously, they're extremely interested to get the best access. They cannot do it now. They have different brokers, banks, but they cannot get good pricing. They ask us a few prices. What are the real spreads you get? What's your platform like? And when we send them ours, they're like, okay, we want to sign up. They didn't even want to do a transaction cost analysis. They were so convinced, and they realized they were paying so much more that they said, I don't even want to know how much it is. Let's sign. This client is being onboarded. We're going to start charging them 5 basis points. So if they trade 10 billion, that's a 5 million client, right? Which obviously is extremely huge. That's one of them in all the remittance space. We're mapping the whole remittance space, and we see huge potential in Asia and LATAM. But that a bit shows as well what we can bring to the table, what the margins can be. The agricultural business Tom mentioned, we're going to be charging 25 basis points, which is much higher than we've modeled, in the initial numbers. So anyway, I think there's a lot of potential in different niche markets out there, and LATAM is one where, we're working quite actively, and obviously my background helps.
Did you have visibility? I'm sorry, Tom, go ahead.
I was just saying it's obviously truly a global opportunity, and we don't have to build a plant in another country or a factory or anything like that. So really a big opportunity.
In that example, Santiago, where the $5 million of revenue would be benefiting the company, did you have visibility on what they would have otherwise been paying? Obviously a lot more than 5 million, but how much more?
It's a good point, and in most of the cases, I would say, we can share different case studies. Like the agricultural one, we will know exactly because we run a transaction cost analysis. On this particular client, honestly, we don't know.
Well, because they didn't. Normally, the client would embrace that.
They didn't need to, right?
They just saw it's just a no-brainer, right? But we suspect, even at those volumes, they were probably paying 25, 30 basis points.
Yeah, I would say
probably 30 basis points. And even from our standpoint, we're not a major FX player, but we do FX trading in some of the funds we manage, and then also for our principal investing activities. As a real example, we acquired a portfolio of apartments in Germany at the end of the year, and we have relationships with banks, foreign exchange players, and we had to exchange, I think it was like 6 or 7 million euros, and the best rate we got was like, I don't know what it was, 32 basis points, right? And I mean, we pushed everybody, and that was kind of that's a lot of money when you consider it's like a 5-second transaction. You throw away 30 basis points on 7 million, and we're not a customer. I mean, we're going to be a customer, but at the time we weren't onboarded or anything like that. And so imagine we paid 5 basis points. You're talking about
Real money. Yeah.
Real money, for example.
Yeah, there's one more thing I will share on that, and again, we will be able to elaborate more. But I think this really shows the potential, how the lack of transparency has been something in the industry. So the parent company, which are one of the, you would argue, the most experts in FX world, and the founder, we know very well, he knows exactly, right, how much you have to pay, and they have built their trading platform to trade on behalf of their clients, right? That's what they do. However, the company, it's also a fiduciary company in the sense that they have offices in different parts of the world. They have to pay salaries, rent, so they have to do some FX, right? I'm not going to disclose size now, but they do some, okay, several millions, right? It's not 2 billion, but it's a few $1 million a year, and they know the space very well. But obviously, for their own company, they cannot use their trading desk, right? Their trading desk is for their asset management, to orders for endowments, sovereign wealth funds, and others. And obviously, they know everyone in the space. They know how fees are, and they were using everything that existed up to now, right? Brokers, custodian banks, and others. Well, guess what? The parent company is becoming a client of the fintech arm. Why? Because even though they know everything and they know they're being ripped off, they cannot get those good rates. Now they're going to be a client. They're going to pay us for that, of course, and they're going to be able to get the same rates they used to get. And this, I think, it really pictures where you say, well, if these guys couldn't get it, don't feel bad if you're a corporate selling t-shirts in Colombia and you are not getting it. Now you can access it. And that's a real pitch, I think, when you go to clients.
Santiago, one of the first things you said to me illustrated it well in sort of layman terms, that people are pretty aware that there's no transparency in FX trading, essentially. But when you said the disclosure of cost of goods sold, people can understand that, right? So your margin is disclosed when you do a trade. Otherwise, it really isn't, right? So you don't know what the bid and ask is oftentimes in this opaque market.
Correct.
That's super instructive. Did I say that right?
Yeah, it's really like that. And this platform, and again, we will be able to share a demo, but you'll be able to see the bid and ask of every competing bank. The fact that there's more than one bank as well, and why this is so powerful, it's you have the top bank showing the top rate, the tier 1 rate at the same time in large sizes. And we've done, as part of the diligence, we did live comparisons with some very large and known brokers, so people that everyone trusts now or think they're the best solution, just compare in terms of size. So this platform, you'll be able to trade up to $150, $200 million in a click for euro dollar. So you're done with a click. It's not that you have to request a quote, or you see the quote, you click, you're done. For lower sizes, you will probably be able to see cross rates, meaning, you'll be able to buy cheaper than what you sell, effectively making money if you will be trying to arbitrage. Obviously, something that it's extremely controlling the platform, but this is how powerful the platform is in terms of pricing. And that's why it really gives you a free way on us on how much you want to charge, how efficient you want to be. And when you think about barriers of entry, you go to someone, now it's going to be a platform you like operationally, lowers operational burden, has some other functionalities like research, trading signals. You may be able to deposit your overnight rates, and at the same time, you're saving 70%. Well, your client retention, get to us, is going to be extremely high, right?
Yeah, super cool.
Arthur, I know we are almost on the time. Is there any more questions? We would love to follow up as well with anyone involved, for sure.
Yep. So I've put the call out for questions, and so we'll see if, as we're wrapping things up here, people have any more. What's the process for folks to get involved?
Well, we would. I'll send an email following up. But of course, I guess everyone has our contact details. I think the best route is to sign an NDA, and then we have a lot of information, data room, and I have an email with the full deck, which is much more complete than this one and others. We'll be happy to share that and open conversations directly. Also, for full transparency, we're very happy to set up a call directly with management as well to deep dive on all the operational side. We've done a webinar with the company that under NDA we can share. There's a lot of more details. We have color in terms of pipeline, who really the clients are. You'll be able to see the names out there. I mean, some names you will know them very well. They're very large, and those are being onboarded right now. So there's a lot more we can share in terms of the visibility, revenues, the ramp up, all under NDA. So I think it's really about signing the NDA and sharing more information and start talking with us and with management as well.
Yeah, well, one of the things you shared with me, I think it'd be important for everybody to know, is that the NDA is just one that is not to protect you from circumvention and not to protect the company from disclosure. It's just a polite NDA, meaning that there's no point in, you're not doing it because there's another opportunity to invest in the company. You're doing it just to be clear about who you're talking to about the opportunity. And I just want the community to know that it's just a polite NDA. It's not, you're being polite to your friends.
Yeah, yes, correct. We even people here from where we are based, we made it sign. I think it's the right thing to do, but there's nothing there sketchy or anything behind it that you're not being said.
Yeah. So thank you folks for being here, and thank you guys for doing this again. I really appreciate it. A super cool opportunity. We'll make sure that everybody gets in touch and you can get in touch with them, and we'll record this and putting it, as I said, on the Family Office Insights YouTube channel, and then we'll put you in direct touch with Santiago. And if you care to get involved, please feel free to do so. And if there's anybody in your community, your network, or colleagues that you think should hear the story, then you're welcome to connect directly with Santiago. You don't need Family Office Insights or me to get in the way of that. So we'll make sure that we connect you directly. And thanks again for doing that.
Thank you very much.
Thanks, Harvey.
Thanks, any comments real quick?
No, we want to thank everybody for joining, and we're very accessible to respond to any additional questions.
Great. Okay, till next time, guys. Take care. Bye-bye.